Let's talk about British American Tobacco. For some investors, it's this incredible dividend-pumping cash machine. But for others, it's a classic value trap, stuck in a dying industry. So, which is it? Today, we're going to dig into the numbers and find out what the real story is. The whole debate really boils down to this one question. Is that huge dividend a sign of a fantastic bargain, or is it actually a red flag for a company that's on its way out? Let's figure it out. Okay, so before we can judge any investment, we have to do something crucial. We need a goal. Without a target to aim for, we're basically just guessing. And the analysis we're breaking down today sets a very, very specific one. And that goal is a 9% average annual return compounded over 16 years. This number is our North Star for this whole explainer. Everything we're about to look at gets measured against one simple question. Can British American Tobacco realistically deliver that 9% a year from where it's priced today? So let's start with the bull case. The reason this stock is so tempting in the first place. We need to really understand what makes this company such a profitability powerhouse. This is the heart of the cash machine argument. The company's strength really comes from its competitive moat. For BTI, that moat has four main parts. You've got these iconic brands that people are incredibly loyal to, massive regulatory hurdles that keep new players out, a gigantic global distribution network, and this last one is the most important: pricing power. They can literally raise prices to make up for selling fewer cigarettes, and people still pay. That's huge. And the result of that powerful moat is, well, it's pretty staggering. A net profit margin over 30%. That puts BTI in an elite club of the most profitable large companies in the entire world. They are just incredibly good at turning sales into pure profit. So here's the key thing to remember. You don't invest in a company like BTI expecting crazy revenue growth. That's not the play here. You invest in it because it's a finely tuned machine designed to harvest massive amounts of cash from a huge, even if it is declining, industry. It is all about the profitability. But, of course, it's not that simple. I mean, if it were, the stock wouldn't be so cheap, right? So now we have to flip the coin and look at the other side, those powerful structural headwinds that make up the value trap argument. And the first major headwind is the debt. We're talking over $35 billion of it. A debt load that large is a huge risk. It really limits the company's flexibility and acts like a heavy anchor if profits start to shrink faster than everyone expects. That debt just makes all these other risks even bigger. You've got governments all over the world getting tougher on tobacco, smoking rates are continuing their long-term slide downwards, the threat of getting hit with a massive lawsuit is always there, and of course, new technologies could come along and disrupt the whole industry. These aren't just minor problems, they are serious, fundamental threats. And this table does a brilliant job of showing that balance. It's a weighted SWOT analysis, which is just a fancy way of scoring the pros and cons. And notice this? The weaknesses and the threats, together, carry half of the total weight in the analysis. The final score of 6.55 out of 10, well, it suggests a pretty decent company, but one that is clearly being weighed down by some significant challenges. Okay, so we've heard the story, we've seen the strengths, we've seen the weaknesses. Now let's get down to the hard numbers. What is this business actually worth? The analysis uses a couple of standard methods to estimate the company's true or intrinsic value. And what's interesting is they both point to a value somewhere around $71 per share, which is quite a bit higher than its recent price. That gap between the value and the price is what investors call a margin of safety. Here, it's about 20%, and it suggests the company is currently undervalued. But valuation is never just one single number, it's a range. In a worst case or bear scenario with tougher regulations, the value is closer to $55, which is not far from where it's trading now. The base case is that $71 figure, but in a bull scenario, if BTI really succeeds with its new reduced risk products, the value could be as high as $85. It just shows you how wide the range of potential outcomes really is. Now, let's tie this all back to our goal. Remember that 9% annual return we're targeting? This table is where the rubber meets the road. It lays it out perfectly. To achieve that 9% return over the next 16 years, this analysis concludes you have to buy the stock at or below $52 a share. All right, we've seen the powerful profitability, we've gone over the serious risks, and we've crunched the numbers on the valuation. It is time to put it all together and land on a final verdict. So, according to the source analysis, here's the core idea of why there might be an opportunity here. The market is heavily discounting BTI stock because of ESG concerns and the whole dying industry story. This has made the stock unpopular and therefore cheap. But the underlying business, while it's definitely facing challenges, is not broken. It's still generating an immense amount of cash. And that thinking leads to this very clear, very actionable verdict. At its recent price, it's a hold. The value is there, sure, but it's not enough to meet our tough 9% return target. However, it becomes a compelling buy if and only if the price falls below that crucial $52 level. So, to sum it all up, BTI is a profitable business, but it's in a declining industry. Its value comes from cash flow and that dividend, not from growth. Right now, there's a decent margin of safety, but those risks we talked about, regulation, debt, they are very real. And most importantly, if your goal is a 9% annual return, the magic number you need to watch for is a price below $52. And that's our deep dive on British American Tobacco, a really fascinating clash between profitability and risk. So, what company's numbers do you want us to break down next? Let us know in the comments. Thanks for tuning in.